The Republicans' wins of the U.S. presidency and the Senate has provided clarity for investors following months of uncertainty that has caused market volatility. The House is yet to be called, although media reports indicate it is leaning in the Republicans' favor. With more clarity on the makeup of government, investors can now focus on what the Donald Trump administration may mean for markets and the economy. Let's take a closer look. President-elect Trump's campaign revolved around extending his 2017 tax cuts, which are set to expire at the end of 2025, a tougher stance on immigration, increasing tariffs, and deregulation. While some of these policies are stimulative, others will increase inflationary pressures on labor and goods. Importantly, with the nation's debt-to-GDP ratio already stretched at 120%, Trump's policies may further increase the U.S. government's debt load to more than 170% of GDP, based on an estimate by the Committee for a Responsible Federal Budget. How might these policies impact markets? As it became increasingly clear overnight that Republicans were going to have a successful evening, markets reacted in kind. While both large and small cap stocks shot higher, there were clear winners to start the day. More domestically oriented small cap stocks were up 6% pre-market, benefiting from certain Trump policies, while large caps were up more than 2%. Banks and energy stocks were notable winners as expected beneficiaries from deregulatory Trump policies. Further, equity market volatility cratered, with the CBOE Implied Volatility Index, or VIX, dropping over 4 points as investors welcome closure on an election cycle that's been highly contentious. For bond markets, the focus was more on the fiscal side. Long rates shot higher, with the 30-year U.S. Treasury up around 20 basis points this morning, consistent with a view of higher term premiums given expectations around increasing deficits and debt. Break-even inflation expectations also moved somewhat higher, aligned with a view towards increasing labor costs and debt expansion. Equity investors need to consider the balance of headwinds and tailwinds from expected policies and how companies are likely to adapt. Higher interest rates could weigh on the valuation of longer-duration growth equities, as we have observed historically. Further, inflationary pressures from increased labor and input costs may be an additional headwind to profit margins. However, the maintenance and potential decrease of taxes and deregulation may boost corporate investment and consumer spending, which would be a tailwind to equity returns. For bond investors, the entire yield curve is in flux. The Federal Reserve embarked on an interest rate cutting regime in mid-September, taking the short-term Fed funds rate down 50 basis points, with expectations for additional cuts. Meanwhile, longer-term rates have moved meaningfully higher since that time. Taken together, this bear steepening reflects both Fed action and investors' views toward government debt and the term premium investors expect. Debt levels will once again come into focus as the U.S. will reach the debt ceiling in the coming months. How this gets discussed and negotiated will be an early indication of whether spending restraint will be shown. Another important consideration is how much stock-bond diversification may change. Historically, stock and bond correlations have been low or negative, which has been a good source of diversification for investors. However, there have been many points in time, notably 2022, where this correlation can turn positive. In that case, it was the combination of increasing inflation and rising interest rates that acted as a headwind to both stock and bond market returns. Given inflationary risk potential, stock-bond correlations are an area that should be top of mind for investors. Perhaps the biggest boon for investors overnight is an increase in policy clarity. Noting the House is still undecided, scenarios for divided government were likely to set up contentious debates surrounding the extensions of the 2017 Trump tax cuts, the debt ceiling, regulation, and more. There are still a number of unknowns surrounding how Trump's policies will be implemented specifically, but the scope narrowed significantly with the election results. So far, the initial market reaction has been fairly in line with the prior interpretations of Trump's policy impacts on asset classes and sector returns. We hesitate to put too much emphasis on a single day and instead recommend a careful evaluation of how policy may impact real and nominal economic variables, interest rates, and fundamentals. While the initial market reaction may provide some clues, we recommend a longer-run view on asset class returns and correlations.